Hello, everybody, and welcome to the JKAM Alternative Investment Fund Overview. My name is William Bonati, and I will be taking you through this presentation. JKAM is dedicated to creating passive income and growth through private real estate opportunities, giving you a better way to build wealth without Wall Street. So starting first with the disclaimer, this is being recorded. So if you want to read it in its entirety, you can review this at a later date. But essentially, this is not an opportunity to invest. You must first read the private placement memorandum and the subscription documents, and this is only appropriate for accredited investors. So Jack and I's aha moment was when we discovered we could get mid-teen to low 20% returns with relatively low risk. We then discovered it was actually safer and more efficient to partner with experienced operators in different markets working together to buy 100 to 300 unit apartment complexes and other commercial real estate. And by being a passive partner, financial partner in real estate syndications versus being an operator, we were able to scale into many markets and asset classes to achieve diversification. We also realized that we could invest passively and still get tax-deferred income due to depreciation. So let's talk about the realities or problems passive investors face when investing in real estate. The first is knowledge. So you need to know how to evaluate commercial real estate, if it's a good investment, or if it even meets the objectives of your investment goals. You need to be knowledgeable about what asset classes to select, whether that is single-family rentals, multifamily, commercial real estate, ground-up construction, value add, what locations or geographies, and which operators, et cetera, et cetera. The list goes on, making this a challenging proposition if you are trying to do this while working full-time. The second is time. The time it actually takes. So don't be mistaken by what you see on HGTV and home flipper shows. Real estate investing is not easy, and it does take a ton of time. To do it effectively, you'll need to network and source opportunities. You'll have to analyze and evaluate those opportunities. You'll need to have the capital to fund the project or those opportunities. And you need to have the right team in place to execute on the business plan or strategy, and much, much more. And after spending all that time working through those processes you need to have in place to be successful, you may only end up with one or two projects. And that leads to the third common problem, which is diversification. Most real estate investors get burned because they rely too heavily on one investment rental or one real estate syndication project. And when there is a bump in the road with a tenant or an operator, your return on investment is really impacted because you only have one or two investments. So diversifying among larger, more stable asset classes like multifamily syndications can also be challenging because of the higher minimum investments required. Most are $50,000, and this means you'll need to have a significant capital outlay to achieve diversification, not just among operators, but geographies and asset classes. So why invest with JKAM? So the JKAM Funds provides the solution to those three major problems. With our experience and expertise, you can participate in quality, stable, risk-averse projects that are hard to source and access if you're not in the industry. The second reason is, as an investor, you get a completely turnkey real estate investment. This means that you're not dealing with tenants and toilets or property managers, the time that it takes to source and evaluate properties, complete the paperwork for each project, deal with multiple or many different K-1s during tax time. And lastly, the third, which is turnkey diversification. So with a single investment into our fund, you'll be diversified across best-in-class operators, projects, geographies, and real estate asset classes, providing you with the advantages of private real estate, which are higher returns, cash flow, and tax advantages. So looking now at our experience, starting in 2001, Jack started buying real estate, focusing on single-family and multifamily rentals. Then in 2008, he joined a New York City private equity fund, which was buying distressed mortgages from banks. In 2010, he launched Gemini Capital Advisors and PRP Advisors. And in 2014, partnered up with a large private equity fund to manage over $3 billion in purchases of non-performing and reperforming mortgage debt between 2014 and 2019. In 2019, Jack and I launched the first JKAM Fund, and we are now on to JKAM Fund 2. So the JKAM's team is fully supported by professionals who know their stuff, and we have strong relationships with established firms, including our fund accounting through Strategic Fund Services, tech-forward investor portals through Avestor for our direct offerings, and Syndication Pro for our diversified funds. These platforms allow our clients to view fund project updates, tax documents, and all fund and project documents. Our legal is through Fisher Broyles. And finally, third-party oversight through Verivest, which does things like background checks on principals and verifies fund holdings. So the JKAM Diversified Real Estate Fund 2 gives passive investors the opportunity to build wealth without Wall Street. And we do so by providing the opportunity for passive accredited investors to invest alongside our firm into alternative investment opportunities. This provides you with passive income and growth, diversified real estate investments across multiple asset classes, markets, and operating partners. You get access to proprietary off-market deal flow. These projects are typically tax advantaged and they have pass-through depreciation. And lastly, you get to take control of your financial future. The JKAM Fund does the due diligence that you don't have time for. So we work on expanding long-term relationships with current operators and develop new relationships through our mastermind groups, industry conferences, and networking. We evaluate and underwrite the operator's experience, track record, and team. We also evaluate and underwrite the project, including the business plan, pro forma assumptions, capital structure, and comps. And then finally, we maintain close communication with operator and team pre and post closing. So the JKAM Fund 2 has equity and fixed share class options. The assets that we will participate in will primarily be multifamily, industrial, triple net, self-storage. The total raise is $20 million. The minimum investment is $50,000. The preferred return is 6 to 8%. The target annualized return, or net IRR, for equity share classes is 15%, and the hold period is 5 to 6 years. Again, the JKAM Fund 2 will be opportunistically allocating towards these primary asset classes, so multifamily value add, triple net lease, industrial, mobile homes, and self-storage. There are 3 share class options. The 2 equity options are as follows. Share class C has a 6% pref, 70-30 split, and a $50,000 minimum. So 70% of the profit goes to investors, 30% to the general partners of JKAM. Equity share class D pays an 8% pref, has a 70-30 split, and is $250,000 minimum. Oops, I skipped that last one there. Fixed share class B is a 12% fixed, so you get 6% in current pay or pref, and then there's a 6% catch up, and that's a $50,000 minimum. So the waterfall for each share class is as follows. So the equity share classes, investors are paid or accrue 6% quarterly from available operating cash flow. Second, investors' capital is returned pro rata each time we exit a deal until 100% is returned. And third, and finally, any remaining profits are split 70% to investors and 30% to the general partners of JKAM. And it's the same for the equity share class D. The fixed share class B, first, investors receive quarterly distributions of up to 6% on their active investment. Second, investors receive any accrued and unpaid distributions up to an additional 6% with a cap or total of 12%. And third, investors' capital is returned pro rata each time we exit a deal until 100% is returned. So here's a look at the Fund 2 current holdings. So as capital is raised within Fund 2, it is deployed into the best deal available in any given month. This gives us the advantage of dollar cost averaging. So original investors get exposure to all of the new assets, and new incoming investors are able to own a percentage of previous deals the fund has already invested in. So the current holdings are as follows. So there's a multifamily value add that's 180 units in West Houston, Texas. We have a nationwide self-storage fund with 20,000 plus units. There's a multifamily value add that's 132 units in Greenville, South Carolina. We also participate in a nationwide private fund with 6,000 plus units. There's a multifamily value add, which is 156 units in Glendale or Phoenix, Arizona. There's a 94 unit multifamily value add property in Fort Lauderdale, Florida. We've got a 300 unit multifamily value add in Houston, Texas. There's a 2 property, 300 unit, or rather 382 unit multifamily value add in Jacksonville, Florida. There's a Beach Island Resort and Marina, or Lakeview Marina and Campground. That's in Maynardville, Tennessee. And lastly, there is a 666 unit 3 property portfolio in Houston, Texas. Again, that is a multifamily value add. So here we are outlining what a $100,000 investment looks like in the equity share class C. You invest $100,000, and in year 1, so you invest $100,000. In year 1, you get a 6% pref for $6,000. So your cash flow for that year looks like $6,000. It's the same in year 2. 6% pref on $100,000 is $6,000. And then in year 3, your cash flow is $56,000 because there may be a sale or an exit from a property, and we're able to return capital. And in this year, we return $50,000. So you get a 6% pref on $100,000 and returned capital. So your cash flow for the year is $56,000. And then in year 4, you're getting 6% on unreturned capital, which right now is $50,000. So that's $3,000. And then we also maybe sell some properties or exit. So you get some more capital, initial capital return of $25,000. So your cash flow for year 4 looks like $28,000. And then in the 5th year, 6% on $25,000 is $1,500. And we return that final $25,000 of your initial capital in the deal. So cash flow for this year looks like $26,500. And then the last couple of years, it's just profit split because we've paid the pref, we've returned your capital, and now it's just profit split. So $15,000 and $15,000. And ultimately, it works out to average around 15% annually. And as we've seen, we are trending well above that based on the current projects in the fund. So we are really excited to have direct investments available as well for those who need to do a 1031 exchange or just like one specific project. So in addition to our diversified fund, investors can participate in select direct investment opportunities. This allows investors the opportunity to invest directly into select properties or even make custom allocations based on their preferences. And similar to our diversified fund, this will be a streamlined process with a user-friendly, tech-forward platform and investor portal. So I'd like to share the Fund 1 track record as an example to what you can expect from Fund 2. So Fund 1 opened to investors in September of 2020. Fund 1 allocated to 34 different properties, primarily in the multifamily and multifamily value add asset class. 2 of those projects have gone full cycle already and have exceeded their initial expectations. And many of the properties are performing well above initial pro forma projections when we first entered them. Fund 1 is now closed and Fund 2 is open. Here we have a high-level look at the Fund 1 holdings. Again, 34 properties, 4 asset classes, 13 states, 22 metro areas, 12 sponsors, 7,500 plus doors. So you can see that you get a lot of diversification in our funds. Looking now, it's highlighting those 2 projects that have gone full cycle already in Fund 1, starting with the Phoenix, Arizona multifamily value add project. You can see some before and after pictures here. This was a 282 unit multifamily value add project that outperformed the initial projected returns by more than 75%, resulting in a 98% return on investment. So our experienced operating partner executed on their value add strategy to force appreciation in a booming Phoenix market and accepted an unsolicited purchase offer, resulting in the sale of this property in 12 months and 2 days. And we have since invested in several other projects with this particular operating partner. Here is the second project in the Fund 1 that has gone full cycle, and this is the Lionsgate Apartments in Greenville, South Carolina. Again, here are some before and after pictures. So you can see a pretty significant difference on the interiors with the before here and the after over here. This was a 144 unit multifamily value add investment that outperformed the conservative initial projected returns by more than 20%, resulting in a 36% IRR. Again, our experienced operating partner executed their value add strategy to force appreciation in a highly desirable submarket of Greenville, South Carolina, and exited this project within 24 months. And we have since invested in another project with this particular operating partner in the same market, which they clearly know very well. So if you'd like to see more detailed information on the fund offering, you can go to jkaminvestments.com/offerings and create an account to view the PPM subscription documents. You can do that there. So thank you very much for taking some time to join us. And if you have any questions, comments, or feedback, we welcome hearing from you, and have a fantastic day.